Okay, welcome back, everybody. So today is August 20th, and this is going to be the lecture for Chapter 1. I'm gonna stop saying the date on it. Just see. Okay, good. Okay, welcome back, everybody. So once again, this is tax for the individual and for business decision making, Accounting 325. This will be our first actual lecture for the course. We'll be doing Chapter 1 today. I did the introduction to the course a few days back. Just want to remind everyone to go ahead and do this introduction link. I think, pretty sure it's already been taken care of. Just want to throw that out one more time. You got till Saturday. You can see here I've already posted these PowerPoint lectures here. This is what I'm going to be going off for the lecture today. I will be posting the homework and the quiz coming up. The quiz is not due till next weekend, so you still have plenty of time to work on it. I do want to apologize for not getting this lecture posted earlier in the week. That won't be an issue moving forward. My goal is to get it posted early on in the week, so next week I'm going to get the lecture posted up earlier as well as the homework and the quiz. But just to remind, the quiz and homework, they're not going to be real long. Just going to be right to the point and do a few of the more detailed problems, the stuff that I find that's the most relevant. Whereas like I said before, I just don't really believe in bogging people down with a bunch of just busy work. So you'll have plenty of time to do the homework. I'll get that posted here soon. So once again, this is Chapter 1, and let's go ahead and get started on it. So Chapter 1 is an introduction to taxation. We have about, I think, 10 learning objectives for this chapter. I'll just run through them real quickly. We want to discuss the history of taxation in the United States, describe the 3 types of tax rate structures, describe the various types of taxes, discuss the criteria for a good tax structure, the objectives of the federal income tax law, and the recent tax reform proposals. Next, describe the tax entities in the federal income tax system, identify the various tax law sources and understand their implications for tax practice, describe the legislative process for the enactment of the tax law, and then describe the administrative procedures under the tax law. All right, and now as we move through these, I'm gonna place more emphasis on certain of these learning objectives over other ones. I don't really want you to focus on certain areas, and then I want you to focus heavily on other areas. So let's just start with the history of the U.S. taxation in the earlier years. And before I get into the history, I'm not really concerned a whole lot with you understanding a lot about the history. Just, get a general idea of, where we started from to how we ended up where we are today. So it says here, government relied on custom duties and excise taxes until 1913. Briefly had an income tax in 1861 to 65 to fund the Civil War. And then the 16th Amendment was passed in 1913 to make federal taxation of individuals constitutional. So 1913, great year for individuals, right? Just joking. Then tax laws were codified into the Internal Revenue Code of 1939, 1954, and 1986. So pretty much this is the main thing here, just when the Internal Revenue Code was codified. In particular, just know that the last huge overhaul was in 1986 when it was actually codified. There have obviously been amendments since then, so that's why any amendments that happens to the tax law will be like as amended for the 1986 one. 1939, less than 6% of U.S. citizens were taxed. By 1974, there were more than 75% of the U.S. citizens that were taxed. Tax revenues are used to fund government operations. I think everyone knows that by now. That's the way the government receives its money, and that's how it operates. So this here just gives you an idea of where different revenue sources actually come from, the percentage of the taxes where it actually is levied. So we can see here individual income taxes accounts for roughly about 48% of the revenue sources. Next being Social Security, that's 35%. Corporate taxes make up 9%, and then the other is 8%. So that's just a typical idea here. And once again, I'm not concerned really about the revenue sources. I just want you to have a general idea of where they're coming from. Okay, next is the types of the tax rate structures. And this one here is pretty important because obviously this is the type of tax rate structures that we're going to be dealing with in the course. So pretty much the structure of individual income tax rates You have the possibility tax rate structures of either being progressive, proportional, which is a flat tax, or even regressive. Currently, the federal tax system in the U.S. is a progressive tax system, and it's going to range anywhere from between 10 to 37%. So in the U.S. here we have the progressive tax rate. Corporate tax rates is the tax rate is for regular corporations, for C corporations. As of now, under the new Tax Cut and Jobs Act, is at a flat rate of 21%. I believe it was down. I think it moved from 39%, 39 or 40%, all the way down to 21%. So that was huge for corporations. It enabled them to be able to make more investments into research and development and expand and hire other people. So that was really good for corporations. Little more on the regressive tax. This is going to be a little bit of a less one. And as you can see here, the progressive one's the highest, the regressive's in the middle, and the proportional is going to be the lowest here. Let's talk a little bit about the type of the tax rate structures. Okay, first we'll start with marginal. Okay, we have the marginal, the average, and the effective tax rates. Okay, marginal tax rates may vary significantly from the nominal scheduled rates. So even though there are nominally scheduled rates, the marginal ones can vary quite a bit. A good example is, say the nominal maximum individual rate is 37%, then the realized marginal rate is going to be higher because of healthcare taxes. So there's other issues that could come into play that could actually make the rate a little higher than what it actually is. Because the federal income tax for individuals is progressive, average tax is always below marginal tax. So as you can see here, the average, how it's pointing downward here on this little wheel type thing, that's just showing that it's always going to be less than the marginal. So this is going to be the highest of the actual tax rate structures. Here is the marginal, right? Then followed by average, and that's so you kind of use these arrows when you're studying to know, okay, marginal's located in the top and it's pointing up, so it's higher. Average is in the middle here and it's pointing down because it's lower than marginal. Okay, so obviously if we look at the effective tax rates and we see that it's at the bottom, then that's going to most likely be the lowest of the three calculations. The reason being that the effective tax rates are going to be lower than the marginal and the average is because the economic income will exceed taxable income under the effective tax rates. Okay, next, this is going to be a really important slide here. This is going to be extremely important because in essence, this is the formula that we're going to be using throughout the semester. This is how you determine the balance due or how much you're going to be refunded, ultimately what your tax liability is. So once again, this is the formula to determine the amount of taxable income or tax due. So if you can see from the top, we start out with total income. Then we take out exclusions. That'll leave us with gross income. From there, we back out deductions, exemptions, and then that'll leave us with taxable income. From taxable income, we then have the tax rate, and then that's gonna be applicable to taxable income. Then we have income tax before credits. So this is where we apply the tax credits next. Then that'll be the total tax liability. And then from there, we want to back out the prepayments. And then that's going to ultimately leave us with the balance due or refunds. So once again, taxable income for all types of taxpayers is going to be calculated by subtracting allowable exclusions and deductions from total income. Then the tax or refund due is going to be calculated by subtracting allowable credits and prepayments from the gross tax liability. And that's going to be from resulting and applying the applicable tax rates to taxable income. So once again, this is very important. This is one of the most important things from this chapter here. Okay, what about other types of taxes? So right here we see we have state and local taxes. So obviously I'm sure everyone's probably had a job at some point or another in your life, and when you receive your paycheck, you can see there's federal taxes taken out with the federal, the Medicare, and the Social Security. And then you're going to have your state withholding. So that's what we're talking about here. You have the state withholding tax. And there's going to be local taxes. A lot of times, for example, in Bluefield, West Virginia, within the municipality of Bluefield, within the state or within the city limits, they actually have a piggyback tax on the sales taxes for the state. The state of West Virginia sales tax is 6%, but it's truly an effective tax rate of 7% if you sell anything within the city limits of Bluefield. So that's a local tax, and it's the piggyback tax. And the way it's done is the businesses will actually remit the full 7% of sales taxes to the state, and then they remit it back to whatever municipality from a Schedule N when you're doing the state sales taxes. So that's a little bit about the state and local sales taxes. We have estate taxes. This is anytime like an individual dies and their estate is to be dissolved. So to whoever the beneficiaries are, it's going to be taxed beyond a certain threshold. We have gift tax. So any individuals that give gifts to another person, like their child or a friend or whatever it might be, there's a certain amount of gifts that you can give, a nominal amount, which obviously is adjusted for inflation yearly. That you can actually give to someone, but after you pass that amount, then you have to, it's going to be applicable to tax or subject to tax. So that's the gift tax. Property taxes, otherwise known as ad valorem taxes, which mean at value taxes. These taxes are going to be levied, and they're going to be done so by an assessor, like a county assessor, for example. Like if you own a home, you're going to be taxed on both your home and your plot of land that you live on, and that, like I said, that the amount of the property taxes or ad valorem taxes is going to be based upon the assessor's appraisal of however they appraise your property for property tax purposes. So that's what property taxes are. You also have to pay property taxes on like vehicles and anything you own. Really, they're going to tax you. Federal excise tax. This is going to be a tax that the feds place on like airline tickets, stuff like tobacco, alcohol, stuff of that nature. So that's what the federal excise tax is. The sales taxes, once again, that's just stuff being imposed due to sales taxes. So if you make sales during or within like a state line or within a municipal line, like we said, from the state and local up top, I use sales tax as an example up there because that is a component of state and local taxes, along with other ones. But sales tax, we get that. That's just a sale. That's a derived tax based. It's derived off the sales of merchandise or services. Employment taxes. That's where if you actually earn your earned income. So if you're going to your 9 to 5 or 8 to 5 job and you get your paycheck, that the taxes that are withheld out of that by your employer, those are employment taxes. And once again, those are going to be like your federal withholding, your Medicare and your Social Security and stuff of that sort. Unemployment tax. This is going to be the only people that are subject to unemployment tax is going to be employers. The employee does not pay that. And there is going to be both federal and state unemployment taxes. And these do vary. There's a threshold on this as well to where only the first a certain amount of an individual's wages are going to be subject to the tax. And once again, recall that this is only a tax that has to be paid by the employer. So that's why when you hear about it's so expensive to hire someone, if you're only paying them $10 an hour, then you're really paying them closer to about $16 or $15 an hour by the time you match their Medicare and Social Security, because the employment taxes, the employer has to match your Medicare and Social Security as well. And like I said, the federal and state unemployment falls solely on the employer. So that's just a general idea of the other types of taxes that are out there at the different levels, and that pertain to the different types of items. So what about the criteria for a tax structure? So pretty much we want to think about the economy, just how ways it can benefit the economy. And we want to try to keep it as simple as possible. So simplicity has to be taken into account. The equity, they want it to be equitable among the people that are having to pay these taxes. So they're trying to make it fair based upon how much money you actually make as to what your tax liability will be. Certainty, we definitely want to make sure that we're certain as to when we're calculating taxes as to where we're not going to have people overpaying them or underpaying them. So we definitely want to have a certain clear-cut law as to what the individual is going to be liable for. And convenient, we want the convenience to be a part of it as well. So obviously, as you can see with all the electronic filings and everything, they're trying to make it a little more convenient. And all this stuff just kind of works as like its own little ecosystem, and just in a way, really, each of them build off each other. So now what about some of the objectives of the federal income tax law? Once again, we have the economic objectives of it. And by meaning of the economic objectives, obviously through tax, through the levy of tax, that we're going to also be promoting certain activities, and we can see this through different social activities, different areas that need the tax money filtered to them. So a lot of that, when we're focusing on the economy, is to promote certain activities and certain social activities. And then also that's going to lead to tax reform. Obviously, there's always going to be room for tax reform because certain individuals at a certain times when the code's been amended are gonna bear more of the burden than some of the other ones. That's just the way it is. You try to make something that's fair for all and an even playground, but unfortunately, it's really hard to do that in reality. And by theory, it's easy to do, but when you actually start practicing it and get out there, it's just a wide open field, and it's a lot harder done than it is said. A lot easier said than done, I guess is the way you should say it. Okay, so once again, on these little criteria, the structure and the objectives, I'm not really too concerned on that, as far as like really being like imperative that you need to know that. Entities in the federal tax system. Now, this is going to be something that's very important. I definitely want to make sure that you all are aware of the different types of entities in the federal tax system. At this point within your college career in the School of Business, I'm assuming if you're in tax, then most likely you're going to be a tax or not tax, but an accounting student, an accounting major. So I would assume that you pretty much know what these different types of business entities are by now. So with having a general idea of what these entities are, let's talk about the tax implications of the different type of business entities. We'll start with tax-paying entities. There's only two of them. Obviously, we have individuals as a tax-paying entity, right? So each individual is going to be subject to income taxes, right? Or whatever, investment income, whatever it might be. Then the other tax-paying entity is that of a C corporation. So recall that C corporations actually are viewed as their own individual entity, right? They stand alone. So if they're protected by like the corporate veil, it was pretty much. So the owners are separate. So the owners do not make up the corporation. The corporation in itself is its own economic entity, right? It's its own individual entity. So that's why the C corps are considered their own tax-paying entities, because they're going to be taxed on their corporate income tax, their bottom line, the same as an individual is going to be taxed on that formula that we got to from the amount of taxes due, or the amount of refund that's due to the taxpayer. So those are the two tax-paying entities, the individuals and C corporations. Okay. Now, flow-through entities or pass-through entities, another word for pass-through or flow-through is like a conduit. So pretty much all these other entities here, the sole proprietorships, the partnerships, S corporations, LLCs, LOPs, and trust are all tax conduits. Once again, a tax conduit is just meaning it's a pass-through. The taxes pass through to that of the individuals. Okay, so that's why these are flow-throughs, because it's going to pass through to the actual 1040s of that of the individual. Sole proprietorships, you should know what these are. Obviously, that's just an individual operating as a sole proprietor. Partnerships, that's when two or more individuals come together, and they share the debts, they share the income, and they usually have an ownership percentage and a partnership agreement that's drawn up between them. In absence of a partnership agreement, it falls underneath the Uniform Commercial Code and stuff, and different laws that are put in place by default if there's not a partnership agreement. S corporations, this is a little bit like C corporations, but it's just structured differently. You can only have one type of stock. You're limited to, I believe, 100 different shareholders, and it's only taxed once. Whereas C corps are subject to double taxation. So it kind of just passes through to the individual. LLCs, LOPs, limited liability companies. They vary by state. The statute vary in the rules vary by states. LLCs is the newest form of business. So that they're still kind of evolving with their rules and regulations. And then LLPs it's another form of a partnership, but it's a limited liability, to where the individuals are not liable for the negligence of their partners. So that's what the LLPs are. And then the trusts, that's going to be mainly taxed where if it's not already been dissolved. And what I mean by the trust being dissolved is like, say the income or whatever's left over in the estate, and within that trust or the estate income, that to the extent that it's not been distributed to the beneficiary. So whatever is remaining by default that has not been split over, that's going to pass through to whoever that individual is that's going to have the tax liability. So once again, just know these different entities. Like I said before, this is very important. We have to know these different type of entities because each of them are subject to different tax laws and interpretations of the law. So that's why it's very important to know that. Components of gross income. We have earned income. Once again, remember that is income that we actually earn while we're at our job, to punching in, clocking out. So when we get our paycheck from our employer, that's earned income. Investments, that could be anything from stocks, bonds, securities, whatever they might be, just whatever you're investing in. And obviously that's so that you're gonna get like your 1099s for that, like 1099 div for dividends, or 1099 miscellaneous if you have miscellaneous income. And the flow throughs, obviously, this is going back to your sole proprietors, your S corps, your LLCs, LLPs, your trust, and stuff of that sort. So flow through is going to all filter into gross income as well. So pretty much gross income is all inclusive income, right? It's your earned income from your job. It's your investment income from investing in the stock markets or your bonds. So your debt and equity investments, and your flow throughs, meaning your little businesses that you have, or businesses that you're an actual part owner in, other than that of a C corporation. So that's important to know the components of gross income. Okay, the for versus from AGI. So pretty much AGI is adjusted gross income. I'm sure when you filed your taxes, if you have filed your taxes before, you've heard of this term before with AGI. Well, in the tax world, this is known as the line, right? AGI is the line, and meaning why it's the line is because anything above it is for AGI, right? So like business deductions. So if you have a business and you have expenses that are deduction worthy, that are capable of being deducted, that's going to tie into effect here. If you have moving expenses, that can tie in for AGI. Individual retirement accounts, and then even down to the SC health insurance. Now below the line, that's going to be different because this is from AGI. So. And below the line, you're either going to take the itemized deductions or the standard deduction, whichever is greater. In most cases, most Americans end up taking the standard deduction because the itemized deductions are subject to thresholds. What I mean by that, if you're itemizing, say if you make charitable contributions, you're limited to making contributions of like 50% of your income, of your AGI is the only thing that's applicable. You can't do anything over that. Other areas, there was a casualty one, and in order for you to be able to claim anything, like it had to be like over a $10,000 threshold. So you could see how you would really have to have some pretty big expenses to itemize to be able to have it greater than the standard deduction. Usually people with a lot of investments and a lot of different flow throughs and earned income that are entering into the determination of their gross income are going to be the ones that are usually going to be itemizing. Especially with the Tax Cuts and Jobs Act, the standard deduction was increased substantially. So with the means of trying to simplify the tax code a little bit, trying to push people into that standard deduction. So with the Tax Cuts and Jobs Act, it's going to be even more difficult to itemize now because you're just getting such an amount to deduct just from taking the standard deduction. So very important, AGI, just know that's the line. Anything above it's for AGI, anything below it is from AGI, okay? So know that. So let's just talk a little bit more about these different type of tax-paying entities. We'll start with corporations. If you recall from the top, they only account for about 9% of the U.S. tax revenues. And remember, C corporations are subject to double taxation, right, on the same income. Okay, so how is that possible? What exactly is double taxation? Okay, so the first level of tax on the C corporation is its taxable income, right? So you have your income statement from your fund principles and your your intermediate accounting courses, Remember, you have the balance sheet, income statement. Well, what they're talking about here is the net income, the bottom line on it. Either you have a net income or a net operating loss. So that's what we're talking about. So they're going to tax that at the applicable rate. And currently under the Tax Cut and Jobs Act, it is 21%, the flat rate. So that's the first level of tax on the C Corp. The second level of tax is going to be imposed when dividends are distributed to shareholders and then taxed at the shareholder level. So the corporation's getting taxed on that income, and then obviously we know how accounting works when net income is close to retained earnings, so it hits the equity. So that equity of the company, that is the component of equity which is retained earnings in excess of dividends declared, obviously has already been taxed. So then if they want to distribute those earnings to the shareholders, what they're saying here is in order to get that money out the company, then that money has to be taxed again. So that's probably the single most biggest pitfall or downfall of a C corporation is they are subject to tax to double taxation. The first level of tax may be mitigated by paying shareholder and employee salaries and bonuses. And as you can see here, it can be subject to IRS tax. So obviously, think about this. If the first layer of tax comes from the net income, right, from on your P&L or on your income statement, what enters into determination of net income? Well, salaries do, bonuses do. They hit your income statement, right? They're reflected directly in there. It directly reduces your income tax liability. So we can see why the IRS might go after them if they're giving really big bonuses and salaries to their shareholders and employees, because it's going to, in essence, they're just reducing their income tax liability and pulling the money out. However, they do still have to pay their personal income taxes, but it kind of gives them that shelter. It allows them to operate under a C corp, but also pull their money out without being taxed twice. So just watch there. Be careful with that one. The second level of tax may be mitigated by the DRD. And this is pretty much the reduced rate for dividends received is all that means for individual shareholders. And you probably touched on that in intermediate. I know it's not you might not have, because it's definitely touched on FAR on the CPA. But pretty much it's just a certain rate. They'll pay dividends in whatever the applicable year is, and only a certain amount of those dividends are going to be subject to taxation. So it's another way for these executives and corporate shareholders to pull money out and kind of, if you will, use a loophole in the tax system to pull money out of the corporation, which is smart. If they're going to give it to you, take it. I mean, they take enough from us. Take whatever you can from them legally. Remember, you don't want to do tax evasion. You want to do tax avoidance. Because the difference between the two is a prison wall. So remember that. Tax evasion and tax avoidance are two different things. Tax evasion is illegal. Tax avoidance is totally legal. You're just using the law for your benefit. Okay. Let's talk a little bit about the tax calculation for corporations. So once again, we have total income, right? And obviously we have our exclusions that we can back out from there. And that's going to equal the business's gross income. From there, we have our business deductions, and then that's going to leave us with our taxable income. So that's the tax calculation for corporations. Okay, tax-paying entities, the flow-throughs. Once again, remember we have the sole proprietor, limited liability companies, the limited liability partnerships, and the S-corps, right? So once again, remember, these are tax conduits, meaning pass-throughs, flow-throughs. They pass through to that of the individual's 1040, right? So let's talk a little more about the flow-throughs or the tax conduits. The flow-through entities are not taxed on any entity level. The income is going to be allocated to the shareholder, the partner, or the member, and taxed on that level, right? So to prevent double taxation of the same income, taxpayers' basis in the entity must be maintained. So they have to maintain that tax base. Flow-through entities may deduct 20% of qualified business income. So what does qualified business income mean? It is net income from business activities, but it does not include investment income, which is interest and dividends and stuff of that sort. So qualified business income, the flow-throughs can deduct 20% of the qualified business income. Remember, that is just strictly the net income from business activities, aside from the peripheral gains and losses from investments and dividends and stuff of that sort. Calculating basis and flow-through entity, obviously add a partner's contribution. So whether the contribution is in the form of cash or property, they also need to take on the share of the partnership debt. From there, you're either going to add or subtract the partner share of the partnership operations. So once again, remember the partnership agreement is going to determine the share of the debt that the partner is going to be responsible for, the share of the income that they're going to have a right to be allocated or a right to receive. So we'll add their income and increase in debt, and then subtract their losses and debt payoff. And then that's going to give us the ending partner's basis. Okay, let's talk a little bit about partnerships. So, what is a partnership? Once again, that's two or more parties that carry on a business. Partners can be individuals, corporations, trusts, or estates. Partnerships need to file an annual return on Form 1065. Entity income and deductions flow through to the partner's K1, Form K1. Net income is not taxed at the partnership level, only at the partner level. So once again, same thing. It's a partnership that they have their operations. They split the money up percentage wise, and then these are just the applicable forms in which you attach onto the schedule, a schedule that you attach onto your Form 1040. And once again, remember that it's not taxed at the partnership level, only at the partner level. Okay, how is forming a partnership accomplished? So let's just assume here at this chart we have two partners, partner A, partner B. Partner A contributes property, partner B contributes money. They each have a 50% partnership interest, and there we have it. We have a partnership entity. That's simple. So what about S corps? Remember, corporation that is treated as a flow-through entity. S corporations can only have a limited number of shareholders. If I'm recalling correctly, it's 100 shareholders. There are limits to the allocation of income and losses, so there is a little more stringent rules that have to be followed because of the benefit of being able to avoid the double taxation. And then the S Corp reports income and deductions on Form 1120S. The allocation of income and deductions reported to the shareholders on Form K1. So once again, flow throughs, you can see kind of the same song and dance, different forms, but the same thing. You get your money, whatever proportionate, whether you're a shareholder, a member, partner, whatever it might be. You get it, it passes through to you, and it's subject to whatever, it ties into whatever your tax liability is on your 1040. A little more on S Corps. Shareholders' basis in S Corporation stock is calculated similar to partnership interest. And then the flow-through nature of income and deductions and basis calculations ensure the single layer of taxation. So pretty much that's the single most, the biggest benefit of the S Corp is the fact that you still have the protection that a lot of the corporations do, but you're just not being hit with the double layer of taxation. So let's talk a little bit about the LLCs here. They can be treated like a partnership for tax purposes, but offers liability protection of a corporation. So that's why I think you see a lot of these LLCs out there. You can really protect yourself. Like I said, you get the protection of the corporation, but at the same time, you get treated like a partnership for tax purposes. So you're really getting the best of both worlds here with the LLC. The LLC owners are referred to as members. So if you are an owner of an LLC, you're a member. And they're going to elect whether the LLC is to be taxed as a partnership or as a corporation. Usually the partnership treatment selects that of the S Corp, the partnership, because of the single layer of the tax, which makes sense. I mean, most times people just don't want to be taxed higher just voluntarily. So LLCs that elect partnership treatment file Form 1065. If elect tax treatment as a corporation, then it must file the Form 1120. Single member LLCs are disregarded for tax purposes, meaning that they're disregarded for tax purposes, meaning that it's just going to flow through to the individual Schedule C for the income and deductions. They're not going to get the option to choose if they want to be treated as a partnership or as an S Corp because they're just a single member. What about the LLPs? It's similar to the LLC, except partners are not liable for the negligent acts of their other partners. So same rules, just in the form of a partnership, and it protects them against the other negligent partners, if there are any. Okay, what about the trusts? This can be taxed either on an entity level or as a flow-through. And most likely trusts are taxed on income not distributed to beneficiaries, as we said before. So it's anything that's left over from the estate or in the trust that is going to be taxed. You file this on Form 1041. And then the trust marginal tax rates go to the highest levels far more quickly than on an individual level. So these trusts are really getting hit over the head hard on the maximum level of tax. Let's talk a little bit about tax law sources. So I'm sure everyone's heard about the three different branches of the government: legislative, executive, and judicial. Well, we can't talk about tax without talking about the law sources and the different branches of the government. So legislative tax law sources include the Internal Revenue Code and congressional committee reports. The executive tax law sources are going to include proposed, temporary, and final Treasury regulations, IRS revenue rulings, revenue procedures, private letter rulings, technical advice memorandum, and information releases. Judicial tax law sources include various levels of court decisions. So that's pretty much the layout of the tax law sources there. There is different amounts of weight given to these different tax law sources, where one ruling will take precedence over the other. So it's important to know that as well. Let's talk a little bit about the legislative process of how an actual tax bill is passed through these different branches of government. So first we come up with the tax bill, right? The first place it goes is the House Ways and Means Committee, in which they hold a hearing with the public, the Treasury Secretary, and the IRS Commissioner. From that point, if it's rejected, the bill dies. If the House Ways and Means Committee, if they approve it, then it's going to be sent to the House, and then it's going to be debated there. If the House rejects it, once again, it dies. If the House passes it, then it's going to go to the Senate Finance Committee. And when it's in the Senate Finance Committee, it's going to hold its own private hearings. Once again, if it's rejected, the bill dies immediately. And if they approve it, then it's going to be debated by the Senate. If the Senate then rejects it, once again, the bill is dead. If they approve it, then the difference between the House and the Senate versions are going to be resolved by the Conference Committee. So pretty much there's a conference committee that are going to try to come through and try to get these people to come to the same terms, pretty much, the two different branches. From that point, if it's approved, then it'll be the reconciled reversion is sent to the House and Senate once again. And then at that final step with the House and Senate, if they approve it, then it goes to the President. If they reject it, the bill dies. So you can kind of see here at any stage, if the bill's rejected from any of them, it just dies and it has to start all over from the beginning. Now, once again, if the reconciled reversion is sent to the House and the Senate and they approve of it, then it then comes to the President and it lands on his desk. And then the President can either veto or sign it. If the President signs it, the bill becomes law. If the President vetoes it, then it's voted on by the House and Senate. If the 2/3 vote rules, or if it's received, if two-thirds say yay to nay, then the bill becomes law. If the 2/3 does not, if 2/3 are nay, then the bill dies. So that's pretty much the legislative process. You might be familiar with the stuff from some governmental courses you've had. It's pretty much the same way most laws are passed. It's a little bit different, but it's pretty much the same routine here. So let's talk a little bit about the organization of the Internal Revenue Service. Important personnel in the IRS, this in descending order, are going to be the Commissioner of the Internal Revenue Service, the Deputy and Assistant Commissioners, the Regional Commissioners, and District Directors. Okay, and you can see here a little bit of the organizational structure up here. You got the Treasury Department up top, and you have the IRS Commissioner, National Office. In the different divisions here, we have the Wage and Investment, the Small Business, and Shareholders. We got the Large Business and International, and then the Tax Exempt. From there, the Tax Service Centers, and at the very bottom, Auditors. So this is all part of the organization of the IRS here. And remember, which is all part of the Treasury Department. Also, it's important to know that unresolved disputes between the taxpayers and the IRS can even, in some cases, lead to litigation. Tax litigation in tax court is handled by the Office of the Chief Counsel. Tax litigation in the U.S. District Court and the U.S. Claims Court is handled by attorneys in the Department of Justice. So just a little bit of background on how, if there's unresolved disputes between taxpayers and the IRS. Okay, let's talk a little bit about audits. So I'm sure we've all probably either had a course in audit by now, or you're getting ready to take one, or maybe you're currently in one. Um, but pretty much auditors are the ones conducting the audits, obviously. So let's talk about in regards to the IRS. So first thing with the correspondence of the letter audits. So with the use of computer analysis and professional judgment, the taxpayer returns are going to be selected for additional correspondence, office audit, or field audit. Mathematical errors and certain matching problems. For example, like the amount of interest on Form 1099 received by the IRS, maybe it doesn't match up with the amount of the interest that was reported by the taxpayer. Stuff like that, little just nuances like that, and like tax issues can generally be resolved by correspondence. Um, and then it's good to note here that 1% of tax returns are selected for audit based on the DIF score. So not very high percentage there. All right, let's talk a little about in-person audits. So in an office audit, the taxpayer is going to be asked to bring documentation to the IRS office. And the reason for the visit there is they want them to be able to substantiate their income, their deductions, and credit items on the taxpayer's returns. So they're really wanting to get a more in depth explanation of how they ended up with their taxes due or tax refund. More complex audits are handled by a field audit, where the actual IRS agent goes to the actual taxpayer's place of business or to the office of the taxpayer's tax professional. So that's the difference between if the in-person audits, they can either come to the place of business or you can go to the IRS office. Disputes between the IRS and agents and taxpayers may be resolved with the IRS appeals division, while the overall individual audit rate is less than 1%. Individuals with relatively large amounts of income and deductions are going to be subject to a higher chance of being audited. This being so because the IRS, the only reason they're auditing you is because they want money, right? They're trying to make it a fruitful audit. Like they're not going to come and audit someone if they think they're not going to spend resources on someone that they think they might get $100 more out of their taxes. So if you have a substantial amount of income and deductions, then they know that something looks off, then chances are they can audit that, and if they find something, then it's going to be more of a material amount to the IRS than that of an individual that makes less. I'm not saying an individual that makes less will never be audited, but it's just not as likely. And if a return contains a frequently disputed item, for example, a home office deduction, the likelihood of audit is also increased. So anytime you use like the home office deduction, a lot of times CPAs will actually they'll stray away from that just because it just kind of throws a flag and gives them a reason for it to be audited more. So just good little thing to know there. Let's talk a little bit about the statute of limitations. So the norm is going to be 3 years from the due date of the return or when the return is actually filed if late. So 3 years from the due date or from whenever the return is filed, whichever's later. A good thing to know, the IRS can come back on you for 3 years is the statute of limitations. So on any of your past 3 years worth of tax returns, you can be come back on from the IRS. The good thing is it goes both ways. You can go back on the IRS too for 3 years. So the statute is not just for the IRS; it's for the individual as well. So if the individual feels that maybe their accountant missed something or they forgot to give some important piece of information to an accountant when they're preparing their tax return, then they can actually go back if it's within that statute of limitations and request a refund or a credit from the IRS. So that's good to know. It doesn't just go in the favor of the IRS. The taxpayer can also has that right to question or challenge the IRS within that statute of limitation. Also good to know that it's extended to 6 years for more than 25% of gross income is omitted on the return. So once again, longer statute of limitations if fraud or understatement of more than 25%. And with fraud, I don't like how they have it if the fraud and understatement of income on one line because fraud, there is no statute of limitations if the taxpayer commits fraud or failed to file a return. It's fair game. It's indefinite. They can come at you if they don't find it for 30 years, they can come after you because it's fraudulent. And once again, 6 years if it's more than 25% of gross income being omitted on your tax return, and if everything's all just oh man, I messed up or I forgot something, and it's 3. And just recall fraud, it's indefinite. Let's say the applicable statute of limitations may be extended by mutual agreement between the taxpayer and the government. So taxpayers are encouraged to extend the statute of limitations when the alternative is an immediate unfavorable notice or of deficiency. The varying lengths of statutes of limitation also can cause record-keeping problem for taxpayers. So pretty much, the best thing to do is just try to stay on top of your taxes and just try to be as honest as possible, because it's no fun to get in trouble with the IRS. Let's talk a little bit about penalties. So we're talking about fraud and omitting income and everything. Let's talk about what the penalties come along with doing so. So FTF is going to be a failure to file. FTP is a failure to pay. Then fraud, obviously we just talked about that. And then accuracy. So obviously accuracy is an issue too. Accuracy comes more in the form of maybe you just weren't as accurate, or you just missed something, underpaid, whatever it might have been. So those are penalties, right? Failure to file, failure to pay, fraud, and accuracy. So let's talk about interest as an element that corresponds with the penalties. So interest and penalties are going to be assessed on tax liabilities that were not timely paid, right? So interest and penalties may apply to taxes due or other taxpayer non-compliance as well. The deductibility of interest paid will be determined under the normal interest deduction rules. And penalties for failure to file, failure to pay, negligence, fraud, etc. are not tax deductible. So obviously, if you get hit with these penalties, you can't deduct them, and you can't net it against your income. Failure to file penalty is going to be 5% per month, up to a maximum of 25%. Failure to pay penalty is going to be 0.5% per month, up to 25% of unpaid liability. And the interest accrues on unpaid liability and penalties. So you can see here where if you have a failure to pay, or the penalties on top of that, then failure to file and failure to pay on top of that, they just keep on accruing on both the liability and the penalties. So that's a bad situation to be in. Okay, let's talk about a little more on interest and penalties. 20% accuracy related penalty, 75% penalty for fraud. Taxpayer can appeal to the IRS if the field or office audits result in an unsatisfactory conclusion. Let's talk a little bit on the components of tax practice next. So tax compliance. Let's talk about tax compliance and procedures. So that's going to be the preparation of tax returns is going to remain a major component of most tax practices. Some major firms have a separate department to deal with tax compliance. So that's pretty much what tax compliance and procedures is pertaining to. Tax research. The tax research process involves determination of the facts, even identification of the problem, or trying to determine what the best solution to the problem is, and then communicating that to the client. So that's what tax research is. You're pretty much just researching issues and just trying to give them the best avenue, or best way to handle their situation. Next, tax planning and consulting. So pretty much on this one, much of the tax professional's value to a client may be in the planning and consulting areas, which in turn is going to minimize taxes paid and maximize after-tax cash flows, while at the same time accommodating clients' desires. That's pretty much a much sought-after commodity in today's complex tax environment. So there's a lot of tax planning and consulting going on. So it's worth paying these professionals the money up front, because paying them that money at the end of the day will free up more cash flow, than what you would have after your income tax liability, because you've planned for it and you've made the right moves, right investments, and you've mitigated whatever your income tax liability will end up being. Next, financial planning. In this area, some tax professionals have added financial planning to their list of services offered. Usually, items analyzed include insurance coverage, investment strategies, and retirement planning. So pretty much that's it for chapter 1. I am going to share something else with you. It's not on this slide. I'll be posting it to our Moodle forum in week 1, right next to this lecture. But pretty much the other thing I'm gonna show you is going to be the tax litigation from the taxpayer's perspective, and it's pretty much just showing how the court system's made up. It starts at the lower level with the tax court, the U.S. District Court, and the U.S. Court of Federal Claims, and then that's the initial forum courts. So then from there it shows how you can appeal if the taxpayer feels that they are right. So they have the right to go to the appellate court. If you're in the U.S. Court of Federal Claims, it'll be appealed to the Federal Circuit Court of Appeals. From that point, if you still feel that you want to make an appeal from there, then you can try to petition the U.S. Supreme Court to try to have your case off there. But only if the Supreme Court approves your case can you try it there. On the other hand, if you're trying in the tax court or the U.S. District Court, if you appeal it to the appellate court level, that's going to be tried or heard in your relevant geographic circuit court of appeals. And from that point, if it's not resolved, then you can try to petition this U.S. Supreme Court as well, and that's once again is only going to be approved by the Supreme Court. The other thing, like I said, I'll post this up so you can get an idea of it, because it is important. I feel like it's kind of good to know pretty much the structure of it if you would have to litigate. And then the next one is just a little flow through chart of some tax law interpretations. It starts out with what the Internal Revenue Code is, the statutory tax law. From there, it goes down to taxpayer interpretations, and then the governmental interpretations, which leads us down to the Secretary of the Treasury, and then the Internal Revenue Service, and then the relative stuff that goes in each of those areas. So once again, that's the end of chapter 1. And remember, I'm going to go through one more time real quick and just point out the stuff that I feel is of most importance. So the history, not concerned about that. I'm not going to test you on anything or quiz you on anything on that. Same thing with the revenue sources. Type of tax rate structures, that's something you could see on these. Just know a little bit about the difference between progressive, regressive, proportional. Pretty much just know, the main thing is just know we're in a progressive one here in the U.S. The individuals are. The type of tax rate structures, know that marginal is the highest, then by average, and then the effective tax rate being the lowest here. So these are important. This one here, very important, determination of taxable income. This is definitely something you will see on a homework or a quiz or an exam. Being so because obviously this is our formula, like I said, that we're going to be building upon throughout the semester. We'll just be getting into more intimate details about it. Other types of taxes, this is important, obviously, to know a little bit about what types of taxes are out there. Criteria for tax structure and objectives of the federal income tax system. I'm not really too concerned. That's nothing I'm going to really be concerned about testing you on. Entities in the federal tax system, very important. You need to know these. So once again, this is something you could expect to see on a homework or a quiz or an exam. So learn the entities in the federal tax system. Shouldn't be hard. You should have a pretty good understanding. This is important to know what comprises gross income, what the components of it are. So know that it's earned income, investments, and flow throughs. That's not bad. Obviously, the AGI being the line, just know that anything above it is for AGI, anything below it is from AGI. We'll get into whatever the components of what is for and what's from later on in the course. Just know now that AGI is the line, and anything above it is for it, anything below it is from it. Corporations, I do want you to know, study these slides through here on the different types of taxpayer entities, just because, like I said, it's important that you know them. Like from up here, how I said this, they're real important. I also want you to be familiar with their characteristics of what they're subject to as far as and concerns as far as their tax liabilities and how they're subject to tax, pretty much. And they're pretty much straightforward. The C corporations and the individuals, are the ones that are the actual the tax-paying entities. The others are flow-throughs. And remember, the flow-throughs pretty much they all operate kind of similarly for tax purposes, so they're not too bad to learn. These little formulas here, I'm not too concerned. We'll get into that at a later time. Once again, know the entities, forming a partnership. We know how that's accomplished. I said, continue to learn these tax law sources. This is important. Like I said, I'm not really too concerned at this point of getting too far into what each one of these components are, because we'll get into them later. And a lot of times, really, when you start getting into these different types of treasury regulations and revenue rulings, that's going to be more focused in like a tax research class. So we'll touch on those a little bit in this course, but for now, I just want to know, you pretty much, if you know the three main branches of the government, you're good. And really, the main thing is just know the legislative process. Have an idea of how it starts in the House Ways and Means, and then goes to the House and Senate Finance Committee, and so on and so forth. So just be familiar with the actual legislative process here. Organization of the IRS, that's important too. Once again, I'm not gonna be testing you on like the different types of divisions and all of that stuff, but it's just, this gives you a little generalization of knowing how the IRS is organized. Audits, is pretty much here. Just know that you can get correspondence or letter audits, and then you can even get the in-person audits. Know the statute of limitations. 3 years for anything that's not fraudulent, or anything that's not been in income omitted of anything less than 25% of gross income. So just know that, and know it for fraud. It's indefinite. There is no statute, or if an omission of 25% or more of gross income, and then it's extended to 6 years. Penalties. Just know if there's a failure to file penalty, failure to pay penalty. Know that interest is going to accrue on both the liability and the penalties. And then the components of tax practice, I'm just have a general idea of what the different types of components of tax practice are. And like I said, we touched on that a little bit. And like I said before, I will be posting those little charts along with the homework and the quiz. And like I said before, the homework and the quiz, they'll be short little assignments. They will cover the most important topics from the chapters. So I've tried my best to point out what I think is the most important topics that I want you to focus your time on. So with that being said, I hope this helps out with covering this material. Once again, I apologize for being a little late getting the lecture posted. Been a little bit of a hectic start to the semester, but I do apologize. So if anything's a little unclear to anyone, please give me a shout. I'll be more than happy to help you out. To be on the lookout for this lecture being posted, and also be on the lookout for those charts I was telling you about, and the homework and the quiz. All right, thank you all. I hope you all have a good day.